Hey folks, Jason Dynison with you, battling a little bit of a cold, so my voice isn't quite as robust as it normally is. If it gives out at any time, please excuse me. But this is another MyCPE One Insights. So let's take a look at some articles from news and notes from around the accounting world over the last couple of weeks. So the US has put tariffs on a number of countries or imports from a number of countries, 39% on Swiss exports or imports into the United States. Now, that affects the pharmaceutical industry, watchmakers as well. And the Swiss government has actually reduced its GDP forecast, the growth in gross domestic product, from 1.2% to 0.9%. Now, Switzerland is pretty steady usually with their economy, but the government is expecting fiscal pain because of the tariffs, and value-added tax is also expected to drop as well. So what does Switzerland send to the United States? What does the US import? Well, we said pharmaceuticals and watches, but also chocolates. And about 17% of all Swiss exports go straight to buyers, and it accounts for 4% of Switzerland's gross domestic product. That's more than double what the rest of the European Union gets from the US market. Now, Switzerland is known for its watchmakers, Swiss watches, and their exports to the US have dropped by over 50% because of the tariffs. Now, the bank UBS is doing well. It posted a $2.5 billion profit in the third quarter. That's up 74% from a year earlier. It cut costs and also had some litigation provisions get clawed back. We have a story also about litigation a little bit later, but this was some litigation that UBS was involved in. So Switzerland's GDP is projected to drop, but the country may be able to weather this storm because inflation is quite low in Switzerland, just 0.2% right now, and projected to be 0.5% next year. So the company First Brands Group has filed a lawsuit against its founder and former CEO Patrick James, saying he defrauded the company of billions of dollars using complex financial maneuvers. So this company is going through bankruptcy, and now they filed a lawsuit against their founder and former CEO. And so First Brands is in Chapter 11 bankruptcy. And this company, they specialize in auto parts, windshield wipers, and brake components. And they had 12 billion, that's billion with a B, in debt, but only 12 million with an M in cash. That's a bit of an upside down balance sheet, isn't it? And so the bankruptcy filing revealed all of this. And, the company had recent expansion, but it was financed with heavy borrowing and fuzzy financial reporting. And so this legal action against the founder and CEO is based on an allegation. It's an allegation. He is alleged to have transferred more than $700 million to himself and his affiliates between 2018 and 2025. And the company says he also borrowed against non-existent or inflated invoices. And so the company is trying to get some of this money back from him. And also, personal expenditures for this guy allegedly came from First Brand's accounts. So, this lawsuit, I mean, there's potential corporate fraud, but there's also, it just highlights risks with private credit markets, lack of transparency, and such. These companies get these loans, but, if things fall apart, it's, as the article says, a domino effect. So the company Kimberly Clark has announced a deal to purchase Kenvue, which is the parent company of brands such as Tylenol, Band-Aid, and Neutrogena, for $48.7 billion. This is expected to increase Kimberly Clark's bottom line revenue by $32 billion and make it the world's second largest health and wellness brand. Investors, though, apparently don't like the deal because the company's stock dropped by 15% after this news came out. It's the largest single day drop for Kimberly Clark in 25 years. So Kimberly Clark, they're already the owners of brands like Huggies, Kleenex, and Cottonelle. And now for $48.7 billion, they're purchasing this company called Kenvue, which is the parent company of Tylenol, Band-Aid, and Neutrogena. So this will make Kimberly Clark the second largest health and wellness company in the world, behind only Procter & Gamble. Now, Kenvue has had some struggles in recent years, with their stock dropping 35% since going public last May. There are lawsuits over baby powder. Texas is suing over Tylenol's alleged autism risk. And President Trump had that public warning where he said pregnant women shouldn't use Tylenol, even though that's been debunked by health officials. There's still just negative things in the news about Tylenol. And so Kimberly Clark is buying Kenvue. Kenvue has had some negative things in the news recently. Now switching to some tax and accounting news here in the U.S. for practitioners and such. Intuit, which we all know from TurboTax and QuickBooks, also MailChimp. They have an AI-powered platform now called Intuit Accountant Suite that will help with things like payroll, client management, business planning, and other accounting operations. So this is supposed to be like an all-in-one accounting suite, basically. As the article says, QuickBooks on caffeine. So there's going to be a team of artificial intelligence agents, a sales tax agent helping keep the business compliant by charging the correct sales tax and suggesting fixes before trouble hits. A payroll agent that'll collect hours, prepare payroll automatically. Now, the article says saving time and avoiding stress. I'm a little bit cynical on things. Hopefully the robots are ready for prime time on something like payroll. If you're turning it over to the AI, it better get it right when it comes to processing payroll. An accounting agent that'll review your books categorizing transactions, doing reconciliations, detecting anomalies. Again, if the AI knows what it's doing, that could be a good thing. If it doesn't, it could create a big mess. And then a couple of things in beta mode, so testing, getting ready to be rolled out. Books close at scale, making multi-client closing smoother. And then AI-powered client insights, which for accountants will take a look at your entire book of business and see where your practice stands. So this is part of Intuit's broader overhaul of its financial technology ecosystem. And it's basically an LLM for accounting data. And they're also updating their enterprise suite ERP aimed at mid-market businesses that are too complicated for basic software, but not quite ready to take the leap into really expensive enterprise-grade ERP. So Intuit, as the article says, they have a very high gross profit margin, but also think about the data that Intuit sits on. And that by extension, I guess, accountants sit on. There's a lot of data out there. And if it can be synthesized, that could be something that not only saves time, but helps accountants with things like advisory services. Now, here's something that I myself wasn't aware that this was even a thing, but I guess it is. You can sell lawsuit claims. Like if you're suing someone and you're expecting to get a settlement, you could sell the settlement to someone else. What are the tax implications of that? Well, one of the things is whose income is it? So if the claim is transferred after your right to the income is fixed, the IRS would say this is your income even if you didn't receive it. Now, if you sell before your right to the money is fixed, then you're probably okay with this. But keep in mind, you better be sure you're going to win, because who's going to buy your potential settlement if there's uncertainty as to whether you're going to win? So you also have issues with things like, what if you're transferring it to a family member, whether it's a family LLC or you're transferring it to your child or something? Watch gift tax. The gift tax limit in 2025 is $19,000. So if your settlement is more than $19,000, you'd need to report it on a gift tax return if you're just straight up giving it to someone. And the basis of that person that you've given the gift to, they might need to report that as taxable income. The IRS can disregard the transfer as well if it's too close to settlement, or if you remain in control of the funds or the case. So, like I say, I haven't dealt with this. I didn't know that this was a thing, but apparently it is. Forbes did an article about it recently. Transferring lawsuit settlements or selling lawsuit settlements before they've happened. Well, the Los Angeles Dodgers recently won the World Series. Their star, Shohei Ohtani. Let's talk about his contract. He has a 10-year, $700 million contract. But most of that is deferred. In fact, right now under his contract, he's making $2 million a year for the next 10 seasons. So it's a $700 million contract, but he is only getting $2 million right now every year. The other $680 million will be paid between 2034 and 2043. Now, who knows how long he'll actually play, but that could potentially be after his career ends. And what might be a smart tax strategy for him? We'll move out of California by then. Move to a state with no income tax, and suddenly that $680 million is free of state taxes. He would be in the 13.3%, the highest bracket in California, on that $680 million. And so this is a tax smart move. It's also something that the Dodgers like as well, because at the Major League Baseball level, there's what's called the luxury tax. That's what it's called. It's not a tax assessed by the IRS. It's a league thing. But when your payroll goes above a certain dollar amount, the league hits you with this tax. And so by deferring $680 million, they're not hit with luxury tax. Well, they might be on their total payroll anyway, but the bulk of Ohtani's contract isn't hitting them with luxury tax right now. Now, what about this part here, the jock tax twist? So many cities that have professional sports franchises have what's called a jock tax, which just means if you play a game in New York, Ohtani, the Dodgers are playing New York, or the Cubs in Illinois, his salary has to be allocated on a day-by-day basis for every day that he's in New York or Chicago. Not just him, all athletes. That's how it works in these cities that have taxes. And of course, the state is going to get its share off of that day by day also. So he's not totally avoiding state taxes with this, but by deferring the $680 million of his contract till later, then he has more options down the road. And then Thomson Reuters has launched an agentic AI tool to help support professionals in the tax, auditing, and accounting world. So their latest innovation is called CoCounsel. And it's not just an AI like LLM that can research things and tell you a code section. It can actually do things. It's agentic AI. And so the headliner of this product is called Ready to Review, which is built for 1040 prep. And it goes through source documents and prior year returns, pulls the right data, and then spits out a tax return that's ready for you to review. And some firms that have tested this say it saves about an hour per simple tax return. And if you have hundreds, if not thousands of clients, and you can save an hour per tax return, if you have 1,000 clients and you save 1,000 hours during tax season, that's almost half a year's worth of work that's been saved. For auditors, there's CoCounsel document analysis and audit intelligence, which helps with evidence matching and work paper preparation. and cuts manual testing by up to 70%. And a CPA who's used this says what once took 2 days now takes about 6 hours. And so the upshot of this is truly agentic, meaning it doesn't just spit out some words as an answer. It actually does the work for you. Now, as we said with the Intuit products, especially on things like payroll processing, or here with like tax prep, the bots better know what they're doing on this stuff, and there always has to be a human to review things in the background. Well, that'll do it for this edition of my CPE Insights. Thanks for joining us. We do this every couple of weeks or so. Hopefully, when we do the next one, my voice will be in a little better shape than it was today. I'm Jason Dynasson. Thanks so much for joining us, and we'll talk to you again soon.